Do you want to make money while you sleep? How about making money every single month without lifting a finger? Do you want to follow the footsteps of the legendary Warren Buffett and achieve financial freedom? If you've answered yes to any of these questions, then you need to watch this video. Because in this video, I'm going to show you the best monthly dividend ETFs in Canada that you can add to your portfolio to help you achieve your financial goals, not just in 2024, but beyond. These are the ETFs that I've handpicked with a lot of research to show you how you can build monthly passive income without the hassle of picking your own dividend stocks. So if you're ready to learn how to invest in these amazing ETFs with me, let's jump right in. This list is in no particular order, and I'm going to show you a sample portfolio at the end of the video of how you can take the pieces I've just talked about and put it all together. But first, let's talk about the first pick, the iShares Canadian Select Dividend Index ETF, ticker symbol XDV. This was launched back in December 19, 2005, as a management expense ratio, or MER, of 55 basis points, has assets under management over $1.4 billion, and has a dividend yield over 5%. The stock price is roughly trading around $27 a share at the time of this video, and has an average annual return since inception of over 5.7%. So I'm looking at these stats. What stands out to me is that it's been around for a very long time, which is a good thing. It's a popular ETF considering it has over $1.4 billion of assets under management, a strong yield at over 5%, and a really good rate of return just shy of 6% per year. XDV is an ETF that aims to replicate the performance of the Dow Jones Canada Select Dividend Index. This is a mouthful to say, but essentially it's an index that tracks the 30 highest yielding Canadian dividend stocks that have a history of paying consistent dividends. And XDV is managed by BlackRock. It's one of the largest asset managers in the world. XDV is a great choice for investors who want to get exposure to some of the best dividend-paying companies in Canada, especially in the financial sector. In fact, close to 60% of XDV's top 10 holdings are invested in some of the biggest banks in Canada, some of the biggest insurance companies in Canada, some of the biggest retailers in the country. And some of these names include CIBC, Canadian Tire, Bank of Montreal, just to name a few. And when you take a look at something like an XDV, it has a solid record of not only paying dividends, but growing the dividends since 2005. It is worth pointing out, though, that XDV does have a high concentration risk in the financial sector, which if you focus on just one specific sector, for example, the financial sector, you're putting yourself at risk of regulatory changes, credit defaults, and so on. So that's one thing to just point out. Overall, XDV is a well-established dividend-focused ETF that offers investors high income as well as the potential for capital appreciation. Next on the list is the BMO Canadian Dividend ETF, ticker symbol ZDV. ZDV has been around since October of 2011, has a management expense ratio of 35 basis points, assets under management of just under $1 billion, a dividend yield of 4.3%. Stock price is just less than $20 a share at the time of this video, and has an average annual return since inception of over 6.6%. So what stats jump out for me in terms of ZDV? Well, it's been around since 2011, so it's been around for over a decade. Has a very low MER ratio at 35 basis points, close to $1 billion of assets under management, also very good. Strong dividend yield, stock price only $20 to get in, and a very good average rate of return. And one of the particular reasons why I like ZDV and what really sets it apart from the rest of this list is that it has a unique strategy in that it selects Canadian dividend stocks based on their yield, their growth, and their stability. It then uses a rules-based approach that considers the 3-year dividend growth rate, the yield, the payout ratio. It's a very dividend-focused ETF with some good rules in place to make sure it selects the best dividend-paying stocks. Essentially, it's doing all the work for you, and you get the ease of owning these best dividend stocks with just one ETF. And that way, you get exposure to a portfolio of high-quality Canadian companies that have a history of paying consistent and growing their dividend over time. You get exposure to a multitude of industries such as financials, energy, utilities, just to name a few. And some of the top 10 names include RBC, the Bank of Nova Scotia, Enbridge, and Bell Canada, just to name a few. And the one downside of ZDV, if I had to nitpick, is that it does suffer from a bit of diversification issues in terms of its sectors. So, for example, you're not going to get access to technology, healthcare, or consumer discretionary. However, having said all of that, it has a rock-solid track record of paying monthly dividends that grow over time, so you get the benefits of dividends and capital appreciation. Overall, ZDV is another great option if you're looking for monthly passive income at a low cost and exposure to some of the best and highest quality dividend-paying companies in Canada. Next up is the Vanguard FTSE Canadian High Dividend Yield Index ETF, or VDY as a ticker symbol. It's been around since November of 2012, has an MER ratio of 22 basis points, and over $2 billion of assets under management, a dividend yield close to 5%, stock price just trading in the low 40s, and an average annual return since inception of close to 9% per year. What really jumps out to me in terms of VDY, very popular ETF if it has over $2 billion of assets under management, an amazing dividend yield of close to 5%, plus it has close to a 9% average annual return. And VDY is a great option because it's a basket of stocks of Canadian companies that pay a high dividend rate. And by investing in VDY, or pretty much any of these ETFs for that matter, you are building your monthly passive income. And you can use that monthly income to either supplement your existing earned income. You can use it to improve the quality of your life. You can reinvest it. Essentially, the choices are yours. You can do whatever you want with that passive income. And VDY is not just about dividends, as you can see from its close to 9% average annual return. It offers exposure to a broad range of Canadian companies across different sectors. And that means you get the benefit of growth and diversification from the Canadian economy, while reducing your risk to just a handful of dividend stocks. And one of the reasons why I like VDY is that it's managed by Vanguard. And Vanguard is one of the world's largest and most trusted investment companies in the world. And Vanguard, it is known for low cost, high quality, and transparent products that aim to deliver the best returns possible. And by doing this, VDY avoids unnecessary costs when it comes to financial services, and it can pass those cost savings on to you, the investor. Overall, VDY is a simple, convenient, and cost-effective way to invest in some of the best dividend-paying companies in Canada. Whether you're looking for income, whether you're looking for capital appreciation, or both, it will help you achieve your financial goals. Next up is the iShares Core S&P TSX Composite High Dividend ETF. These ETFs are such a mouthful to say, but the ticker symbol for this ETF is XEI. It's been around since April of 2011, has an MER ratio of 22 basis points, and assets under management of less than $1.4 billion, a dividend yield of over 5.6%, stock price is less than $25 a share at the time of this recording, and an average annual return since inception of over 6%. So what's really jumping out at me when I look at these stats is low MER ratio, super popular with over $1 billion of assets under management, a very healthy dividend yield of 5.6%, and a steady rate of return at over 6% per year. XEI is also managed by BlackRock. It's another large investment company and one of the most trusted companies when it comes to financial products. XEI is known to follow a passive strategy that tracks the performance of the S&P TSX Equity Income Index, which is essentially a benchmark that represents the Canadian market for high dividend paying stocks. By doing so, XEI also avoids unnecessary trading costs, and it can pass on the savings to you, the investor, just like VDY. This is a low-cost ETF that offers one of the lowest management fees and MERs when it comes to this list. And when we take a look at the top 3 holdings, you'll see names like TD Bank, you'll see Enbridge, you'll see RBC. If I had to essentially summarize the benefits of XEI into 3 simple points, it would be that it pays a monthly dividend income, it's low cost, and for income seekers, it's designed to be a long-term core holding. Last on this list is the iShares S&P TSX Canadian Dividend Aristocrats Index ETF, or CDZ as a ticker symbol. It's been around for a very long time, since September of 2006, meaning it survived the financial crisis. It has an MER ratio of 66 basis points, assets under management of less than $1 billion, dividend yield of just over 4%, and it's trading roughly around $31 a share at the time of this recording, and an average annual return of just over 6%. So what stands out to me when I look at these stats, one is that it's been around since before the financial crisis, as we just talked about. The MER ratio, that's one that bothers me a little bit because it's on the high side, especially for a monthly dividend ETF. Not a bad dividend yield at over 4%, and a pretty good rock-solid average annual return of 6%. And CDZ is really a fund that seeks to emulate the performance of the S&P TSX Canadian Dividend Aristocrats Index. And that's what sets it apart from the other ones we've talked about. And the really cool thing about CDZ is that you get exposure to a diversified basket of high-quality Canadian dividend-paying companies that have increased their dividends every year for at least the last 5 years. And this CDZ ETF is one of the easiest ways to invest in the Canadian Dividend Aristocrats without you having to go through all the research, without having to screen the stocks. It's just quick and easy, and you get good exposure to the Canadian Dividend Aristocrats. And if you take a look at the top holdings, you'll see names like CIBC, Power Corp, Manulife. The MER, as I talked about, it's a little bit high for my liking, but it gives you a quick and easy way if you want to benefit from the Canadian Dividend Aristocrats. Let's go ahead and summarize everything we just talked about and what this sample portfolio can potentially look like when it comes to these ETFs. So over here, I summarized the 5 ETFs listed over here, their current trading price, the yield of those ETFs, how much they pay on a monthly basis. And this section here shows you how much you would have to invest if you want to generate, for example, $1,000 a month in passive income, $2,000 or $3,000. And here is their market cap or their assets under management and the expense ratio for these ETFs. So if I had to pick one out of these 5, my top pick would go to VDY. One, because I'm a huge fan of Vanguard. And besides the fanboying about Vanguard is that it offers a pretty good yield at close to 5%. It's one of the cheapest in terms of expense ratios on this list at just 22 basis points. You can see it's very popular at over $2.2 billion of assets under management. So if I put all my money into VDY, and if I want to generate $1,000 a month in passive income, I would have to put down $250,000 or $750,000 to generate $3,000 a month. If I had to choose a runner-up for this list of ETFs, I would choose the XCI High Dividend Yield ETF. One, because it has one of the highest yields on this list, $25 to get in, and you'll notice that you only need about $640,000 to generate $3,000 a month in passive income. That's about $110,000 less than VDY. It's also super popular at $1.5 billion of assets under management, and just like VDY, one of the lowest expense ratios on this list. So how can you, the investor, build a portfolio with these 5 picks? For example, if I want to put all my money and I only have $10,000 to work with, and I want to put it all into VDY, I'm going to put in 100% over here. What this shows you is that at $10,000, I can pick up about 235 shares of VDY and generate monthly income of just shy of $40 a month. Annually, that's just less than $500 a month, and you can see my annualized yield of 4.79%. But maybe I can't pick just one, and I want to pick 2 of them, and I want to go with the top pick at VDY, and I want to go with my second option at XEI. Now, you may hear this that there's really no point in investing in more than one because there's a lot of overlap, and I agree to that fact. But at the end of the day, what I really care about is as long as you are making an informed decision, as long as you understand what you are investing in, what you are getting, what the growth prospects look like, what the pros, the cons look like, as long as you are making an informed decision, you can pick 1, 2, all of them. It is your decision. And as long as you understand your decision, that's what I care about. So moving on, if I put half in VDY, half in XEI, and I have $10,000 to invest, my monthly income is now $43 a month, and I'm looking at about $520 per year in passive income at a yield of 5.2%. And just for argument's sake, if I want to put down $10,000 in all of them, well, then I go do something like this, 20%, 20%, 20%, and 20%. So I have 100% allocated across all 5 of them. I'm picking up about 368 shares combined, and my monthly income is now $40 a month or $480 per year at an annualized yield of just under 5%. And you can use this spreadsheet to play around. Maybe you don't have $10,000, maybe you only have $5,000. So if you're pretty much investing $1,000 into each ETF, or if you're a real high roller and you have $100,000 to play with, then you can see that at $100,000 across the board, you can generate passive income of $5,000 a year or about $400 a month at a yield of just under 4.82%. And I'll leave a link to the spreadsheet so you can download it, you can play with it. Let me know your thoughts on the spreadsheet on what portfolio you are thinking of for your own dollars. And that's it for today's video. Hopefully you had some great takeaways from this list, and hopefully you can use that spreadsheet that I just showed you to help build your own portfolio of dividend-paying ETFs. As you can see, dividend-paying ETFs is a great way to build income and capital appreciation. Yes, there are risks associated with dividend ETFs, but you have to do the pros and cons and see if it makes sense for your profile. But the real benefit about these dividend-paying ETFs is that instead of you having to do all the work, all the research, and picking your own individual dividend stocks, you get a basket of predefined ETFs that is changing with the market or changing based on the rules that these ETFs select. So you are always getting exposure to some of the best high-quality dividend-paying companies with just one ETF. And the best part is these ETFs will pay you on a monthly basis, no matter what the economic conditions are, no matter what's happening in the market, good news, bad news, etc. You get paid passively every single month. Start investing in these amazing ETFs. It doesn't even have to be this list. It can be another ETF. At the end of the day, you want to start investing and building your own passive income so you can get to financial freedom. If you like this video, give it a thumbs up, hit subscribe if you haven't already, and do me a favor, hit that thanks button, because a small token of appreciation goes a long way. And please check out the links in the description. It's another great way to support this content, this channel, and I can keep making more videos like this. That's it for now, and I'll talk to you in the comment section.